Let me ask you something. If you had $10,000 right now and you had to put it somewhere to build real wealth, what would you choose? A lot of people would say real estate. You can see it, you can touch it. Your parents probably told you property is the safest investment you can make. And honestly, that feels true. But then there's another group of people who say, just put it in an index fund, stop overthinking it, and let it grow for 30 years. So who's actually right? Today, we're going to settle this debate once and for all. We're not just going to look at returns, we're going to look at risk, effort, flexibility, and what each one really feels like when life gets complicated. Because the honest truth, most comparisons you'll find online are incomplete, and that incomplete picture might be costing you a lot of money. Quick disclaimer, this is not financial advice.
Before we get into the battle, let's make sure we're comparing the right things. When I say index funds, I mean a fund that tracks a broad market index, like the S&P 500. You put money in, you instantly own a tiny piece of hundreds of companies, and your investment grows as those companies grow. Simple. When I say real estate, I mean buying a physical property, either to rent it out and collect income or to sell it later at a higher price. Most people do both. Now here's the first thing most comparisons get wrong. They compare the average return of each and stop there. But average return is only one piece of the puzzle. What really matters is total return, after costs, after taxes, after your time, and after the stress it puts on your life. That's what we're actually going to compare today. Let's start with the number everyone wants to know. Which one makes more money? Historically, the S&P 500 has returned around 8 to 10% per year on average. After adjusting for inflation, closer to 7%. That's with zero effort on your part. You don't manage anything, you don't fix anything, you just hold. Real estate is trickier to measure, but studies suggest residential real estate has returned around 4 to 8% per year when you include rental income. Without rental income, just price appreciation, it's closer to 3 to 4% after inflation, historically. So, on raw numbers alone, index funds look stronger. But here's where real estate investors will push back, and they have a point. Real estate lets you use leverage. That means you can buy a $300,000 property with only $60,000 of your own money. If that property goes up 10% in value, you haven't made 10% on your investment. You've made 10% on $300,000, which is $30,000, on a $60,000 investment. That's a 50% return. That's the power of leverage, and index funds simply cannot offer that. So, when leverage is used wisely, real estate can absolutely outperform index funds in terms of raw return on investment. Round one, draw. It depends heavily on how you use leverage and which market you're in. Now let's talk about something people seriously underestimate: costs. With index funds, the fees are almost invisible. We're talking expense ratios as low as 0.03% per year. On a $10,000 investment, that's $3 per year. That's it. No maintenance, no repairs, no insurance, no property taxes, no tenants calling you at 11 p.m. because the heating broke. Real estate is a completely different story. When you buy a property, you're paying closing costs, typically 2 to 5% of the purchase price, property taxes every single year, insurance, maintenance and repairs. Experts recommend budgeting 1% of the property value per year. Property management fees, if you hire someone to manage it, typically 8 to 12% of monthly rent, and vacancy periods, months where you have no tenant and zero income. Add all of that up, and the real cost of owning a rental property is much higher than most beginners realize going in. This doesn't mean real estate is bad, it means you need to calculate the net return, not the headline number. Round two, index funds win clearly. This is the round that nobody talks about, honestly. Investing in an index fund takes about 15 minutes to set up. After that, you do almost nothing. You can automate monthly contributions, you can go on vacation, you can forget about it for a year. The fund keeps working whether you're paying attention or not. Real estate is essentially a second job. Finding the right property takes months of research. Getting financing takes time, closing the deal takes time, and then the real work begins. Tenants, maintenance, legal issues, renovations, insurance claims. Now, some people genuinely enjoy this. They like the hands-on nature of it. They find it satisfying to build something tangible. But if your goal is to build wealth without sacrificing your time and energy, index funds are not even close to real estate in terms of convenience. Round 3, index funds win by a mile. Both investments carry risk, but they carry very different kinds of risk. Index fund risk is mostly market risk. When the economy has a bad year, your portfolio drops. In 2008, the S&P 500 fell nearly 38%. In 2020, it dropped 34% in just 5 weeks. These drops are painful to watch, but historically, every single time, the market has recovered and gone on to reach new highs. The key with index funds is that you don't lose money unless you sell during the crash. If you hold, you wait for the recovery. Real estate risk is different. It's more concentrated. You don't own 500 properties across different industries and countries. You own 1 or 2 properties in one city. If that city's economy weakens, if a major employer leaves, if crime rises, if the neighborhood changes, your investment suffers and there's nothing you can do about it. Real estate also carries liquidity risk. If you need your money quickly, you can't sell a house in a day. It could take months. Index funds, you can sell in seconds. And then there's leverage risk. The same lever that amplifies your gains also amplifies your losses. If a $300,000 property drops 20% in value, you've lost $60,000, which is your entire initial investment. Round 4, slight edge to index funds for most people. Real estate risk is manageable, but it requires experience and a financial cushion.
This might be the most important round of all. The best investment in the world is worthless if you can't stick with it emotionally. Here's what's interesting about real estate psychologically. It's actually easier for most people to hold through hard times. Why? Because you can see it. You drive past it. Your tenants are paying rent. Even when the market value drops, it doesn't feel as real because you're not watching a number on a screen change every second. Index funds are the opposite. Every time the market drops, you open your app and see your portfolio down 20%, 30%, 40%. That number is right there, real, visible, and it triggers every instinct to do something, to sell, to protect yourself. Studies consistently show that investor behavior is the biggest reason people underperform the market. Not fees, not bad funds, behavior. People buy high and sell low because they panic. This is where real estate has a genuine psychological edge. It forces patience through inconvenience. Round 5, real estate wins on psychology. So, after 5 rounds, what's the honest answer? If you're looking purely at simplicity, cost, liquidity, and long-term data, index funds are the stronger choice for most people. They require almost no effort, the fees are tiny, and the historical returns are strong. You don't need to be rich to start. You don't need experience. You just need consistency and patience. Real estate, on the other hand, is genuinely powerful, but only when you have the capital to leverage wisely, the time to manage it, and the knowledge to pick the right market. In the right hands, real estate can absolutely outperform index funds, but those hands need to be experienced. Here's what I actually believe, and this is backed by the data. For most beginners, index funds are the smarter starting point. They build wealth quietly, automatically, and without demanding anything from you. But the wealthiest investors in the world rarely choose only one. They use index funds as their foundation and add real estate when they have the knowledge and capital to do it properly. The biggest mistake isn't choosing real estate over index funds or the other way around. The biggest mistake is waiting to decide while your money sits in a savings account, losing value to inflation every single day. If this video helped you think more clearly about where to put your money, please hit the like button. It genuinely helps this channel reach more people who need this information. And if you want to go deeper, I'll leave a video right here on exactly how to start investing in index funds step by step. Everything you need in one place. Thanks for watching, and I'll see you in the next one. Bye.